Imagine this for a second. It's 2026. Prices are higher than ever. Social media is full of people claiming they got rich overnight. And you're sitting there with your very first $1,000, wondering if this small amount even matters. Most Americans feel exactly like this. According to real U.S. financial data, nearly 60% of Americans can't handle a $1,000 emergency without stress. Yet at the same time, millions of ordinary people quietly used their first $1,000 to change the entire direction of their lives. This script is not about hype, crypto miracles, or becoming a millionaire in 30 days. This is about how real Americans in 2026 can take their first $1,000 and turn it into something powerful, something that gives them control, confidence, and momentum. If you stay until the end, you won't just know where to put the money, you'll understand how to think like someone who builds wealth for life. Before you invest a single dollar, the first and most important step is mindset, because money follows behavior, not the other way around. In America, most people are trained to see money as something to spend, not something to deploy. Your first $1,000 is not extra cash, it's a tool. Think of it like a seed. A seed doesn't look impressive, but planted correctly, it grows for decades. In real life, many self-made investors in the U.S. didn't start with huge salaries. They started with discipline. They learned to delay gratification, to say no to impulse purchases, and to stop trying to impress people who don't pay their bills. This $1,000 represents your decision to step out of survival mode and into ownership mode. Now let's talk about something most people skip, but research proves it's critical: protecting yourself before investing. If you don't have at least a basic emergency buffer, investing can actually increase stress. In 2026 America, unexpected expenses are common: car repairs, medical copays, rent increases. That's why the smartest move is to immediately separate your $1,000 into mental buckets, not physical envelopes, but intentional purposes. For many first-time investors, the right move is to place around $300 to $400 into a high-yield savings account. This is not to get rich, this is to buy peace of mind. Real data shows people with even a small emergency fund are far less likely to pull money out of investments at the worst possible time. That emotional stability alone can outperform risky strategies. Once you've protected yourself, now comes the part people actually get excited about: investing for growth. In 2026, the American market offers more access than ever before. You no longer need a financial advisor or thousands of dollars. With as little as $1, you can own pieces of the biggest companies in the world. This is where beginners should focus on simplicity, not complexity. Real research from decades of market performance shows that broad market index funds outperform most individual stock pickers over time. These funds quietly own companies like Apple, Microsoft, Amazon, Google, and hundreds more. You're not betting on one winner, you're betting on the long-term growth of the U.S. economy itself. For your first $1,000, allocating around $400 to $500 into a low-cost S&P 500 or total market index fund is one of the most proven strategies in American investing history. This isn't theory. This is backed by nearly 100 years of market data. Even people who invested right before crashes and kept going came out ahead over time. The emotional part is key here. The market will go down, that's guaranteed, but history shows it also recovers and grows. The investors who win are not the smartest, they're the most patient. Now let's address something most guides avoid: fear. Fear of losing money, fear of making a mistake, fear of starting. In real life, the biggest financial regret Americans report is not losing money in the market, it's never starting at all. Many people waited for the perfect time, and that time never came. Your first $1,000 is not about perfection, it's about participation. Even if you make small mistakes, the lessons you learn are worth far more than the dollars themselves. This is how confidence is built. In 2026, technology also gives you an edge previous generations didn't have. Fractional investing allows you to invest small amounts consistently. Automation allows you to invest without relying on motivation. One of the smartest things you can do is set up automatic contributions, even if it's just $25 or $50 a month after your initial investment. Research from U.S. behavioral finance shows automation dramatically increases long-term success because it removes emotion from the process. You invest when the market is high and you invest when it's low, without trying to time anything. At this stage, some people ask, what about riskier investments? What about faster growth? This is where discipline separates builders from gamblers. Yes, small portions of your money can be used for higher risk opportunities later, but not before you've built a stable core. Real-life stories of success almost always include a boring foundation. The flashy wins are rare and often exaggerated. The quiet compounding is real. Another powerful use of your first $1,000 is investing in yourself, but not in the way social media sells it. This doesn't mean buying random courses or chasing gurus. It means practical skill building. In America, skills directly translate to income. Allocating a small portion, maybe $100, toward learning a high-demand skill can multiply your earning power. Data shows skills like basic data analysis, digital marketing, AI tools, or even trade certifications can significantly increase income within a year. Higher income means more money to invest, which accelerates everything. Emotionally, this journey changes how you see yourself. You stop feeling behind. You stop feeling helpless. You begin to see money as something you control, not something that controls you. Your first $1,000 won't make you rich, but it will make you different. And different choices, repeated consistently, create different lives. As this first part comes to a close, remember this. The goal in 2026 is not to beat everyone else. The goal is to build something steady in an unstable world. You're not late, you're not too small. You're early the moment you decide to start. In the next part, we'll go deeper into how to balance risk, avoid the biggest beginner mistakes Americans make, and how to structure your investments so they actually fit real life, not just theory. Stay with me, because this is where clarity turns into confidence. Now let's go deeper, because this is where most first-time American investors either build a strong foundation or quietly sabotage themselves without realizing it. By this point, you've accepted that your first $1,000 is a tool, not a lottery ticket. The next step is understanding risk in a way that actually matches real life, not headlines. In the U.S., people often think risk means losing everything, but real risk is more subtle. Real risk is inflation slowly eroding your savings. Real risk is staying in cash for 10 years while prices double. Real risk is panic selling during a market drop because you never prepared emotionally. When you understand this, your entire approach to investing changes. One of the biggest mistakes American beginners make is trying to copy what they see online. They hear about someone who doubled money in a year and assume that's normal. It's not. Real research shows that consistency beats intensity almost every time. The average long-term return of the U.S. stock market has been around 8 to 10% annually, and that includes crashes, wars, and recessions. That may not sound exciting, but over time, it's life-changing. A single $1,000 invested and left alone can grow into several $1,000s over decades, and that's without adding anything else. When you do add consistently, the effect multiplies. Now let's talk about diversification, because this is how you reduce stress while increasing your chances of success. For your first $1,000 in 2026, you don't need dozens of investments. You need balance. A realistic structure many Americans can use is this. A solid core in broad market index funds, a small exposure to bonds or bond funds for stability, and a limited portion for personal growth or controlled experimentation. Bonds may not sound exciting, especially in a culture obsessed with fast gains, but historically they act as shock absorbers during market downturns. Even a small allocation can help you stay invested when stocks fall, and staying invested is where the real returns come from. Another emotional trap is checking your investments too often. Studies from U.S. brokerage data show that people who check daily tend to make worse decisions. They react instead of think. Your first $1,000 deserves a long-term plan, not daily judgment. In 2026, with constant news alerts and social media noise, protecting your focus is part of protecting your money. Set a schedule. Maybe you review monthly or quarterly. The rest of the time, live your life and let compounding do its work. Taxes are another area many beginners ignore, and in America, that can quietly cost you money. Understanding basic tax-advantaged accounts can make a huge difference. For many Americans, investing through a Roth IRA is one of the smartest moves. You invest after-tax money, and your growth can be withdrawn tax-free in retirement. Even small contributions early in life can outperform much larger contributions made later, because time is doing most of the work. This isn't speculation, it's math. Research consistently shows early investors have an enormous advantage, even if they start small. Let's pause for a moment and talk about real people. Not celebrities, not influencers, just regular Americans. Teachers, nurses, warehouse workers, office assistants. Many of them started investing with amounts even smaller than $1,000. They didn't have special knowledge. What they had was patience and a system. Over time, they watched their confidence grow alongside their accounts. That confidence spilled into other areas of life. They negotiated salaries better. They took calculated career risks. They stopped living paycheck to paycheck. This is the hidden power of investing early. It changes how you see the future. At some point, you'll experience your first market drop. It might happen weeks after you invest or years later. When it happens, emotions will hit hard: fear, regret, self-doubt. This is where preparation matters. Remember that market drops are not failures, they're features. Every major long-term investor has lived through multiple crashes. The ones who succeeded didn't avoid them, they stayed. Data from past recessions shows that investors who continued buying during downturns often saw the strongest long-term results. It feels wrong in the moment, but history rewards those who think long-term. Now, let's talk about something practical: simplicity. The more complicated your plan, the more likely you are to abandon it. Your first $1,000 plan should be so simple that you can explain it in one sentence. Something like, I invest regularly in low-cost index funds and let time work for me. That's it. Complexity is often just disguised anxiety. When you keep things simple, you give yourself room to grow. In 2026, artificial intelligence, automation, and global shifts will continue to reshape jobs and markets. This creates uncertainty, but also opportunity. By investing early, you position yourself on the side of growth instead of fear. You're no longer just watching the economy happen to you, you're participating in it. Even small ownership changes your mindset. You start caring differently about innovation, productivity, and long-term progress. Another powerful habit is tracking your net worth, even if it's small. Not to obsess, but to stay aware. Awareness creates intention. When you see your investments slowly grow, you're less likely to sabotage yourself with unnecessary debt or impulse spending. Real-world behavioral research shows people who track progress are far more likely to stick with long-term goals. As we move forward, remember this truth: investing is not about intelligence, it's about behavior. You don't need to predict the future. You need to build habits that work no matter what the future brings. Your first $1,000 is teaching you how to think in decades, not days. That shift alone puts you ahead of most people. In the next part, we'll talk about how to handle mistakes without quitting, how to adjust your strategy as life changes, and how Americans in 2026 can turn this first $1,000 into a system that runs almost on autopilot. This is where investing stops feeling scary and starts feeling empowering. Stay with me. By now, something subtle but powerful is happening. You're no longer just listening to advice, you're starting to see yourself as an investor. That identity shift matters more than any single dollar amount. Most Americans never make this shift. They see investing as something other people do. But once you invest your first $1,000, even imperfectly, you cross a psychological line. You stop being an observer and become a participant, and that changes how every future financial decision feels. Let's talk honestly about mistakes, because they will happen. In real life, every investor makes them. You might buy something right before it drops. You might sell too early. You might hesitate and miss an opportunity. The difference between people who build wealth and people who quit is not intelligence, it's forgiveness. Successful American investors don't expect perfection from themselves. They expect learning. Research into investor behavior shows that those who view mistakes as tuition, not failure, are far more likely to stay invested long enough to succeed. One of the smartest ways to protect yourself from major mistakes is to set clear rules in advance. These rules are not complicated. They're emotional guardrails. For example, you might decide that you never sell an investment just because of headlines, or that you only rebalance once or twice a year. You might decide that any money you invest is money you won't need for at least 5 years. These simple rules prevent emotional decisions during stressful moments. In America's fast-moving media environment, these guardrails are priceless. As your life changes, your investment strategy should evolve, but slowly. In 2026, many Americans are dealing with career shifts, side hustles, family responsibilities, and economic uncertainty. Your first $1,000 is the beginning, not the final version of your plan. When income increases, contributions increase. When responsibilities grow, risk might decrease. This flexibility is a strength, not a weakness. Real financial stability comes from adaptability, not rigidity. Let's address debt, because it's a reality for millions of Americans. High-interest debt, especially credit card debt, is one of the biggest obstacles to investing. If you're carrying debt with very high interest, paying some of it down can actually be a better investment than the market. This is not opinion, it's math. Reducing a 20% interest rate is a guaranteed return. Many Americans find balance by investing a small amount to stay consistent while aggressively reducing high-interest debt. This keeps momentum without ignoring reality. Another overlooked factor is environment. Who you listen to matters. If everyone around you thinks investing is dangerous or pointless, it will affect your behavior. Successful investors often limit how much noise they consume. They choose a few trusted sources, focus on long-term data, and ignore constant predictions. In 2026, information overload is one of the biggest threats to good decision-making. Simplicity and selectivity protect your progress. Now let's talk about compounding, but not just mathematically. Compounding works on habits, confidence, and income. When you invest regularly, even small amounts, you build discipline. That discipline spills into other areas: saving, learning, career growth. Many Americans who started investing early report that it pushed them to think bigger about their careers, to ask for raises, to switch jobs when undervalued. Your first $1,000 can indirectly earn far more than its market return by changing your behavior. There's also an emotional reward that doesn't get talked about enough: peace. Knowing that you're building something in the background reduces anxiety about the future. Even during tough times, you know you're not standing still. This sense of forward motion is powerful, especially in uncertain economic climates. Real-world psychology research shows that progress, even slow progress, improves mental well-being. At some point, you'll notice that investing becomes less exciting, and that's actually a good sign. The goal is not constant adrenaline. The goal is stability. Boring investing often outperforms exciting investing. When your system is set up correctly, you don't need to think about it every day. You live your life, and the system works quietly in the background. This is what financial maturity looks like. In America, many people chase financial freedom without realizing it's built through consistency, not shortcuts. Your first $1,000 is teaching you patience. It's teaching you to trust a process. And most importantly, it's teaching you to bet on yourself and the future. Even when the news is negative, even when markets are volatile, human innovation continues. Businesses adapt. Productivity grows. Long-term investors benefit from that resilience. As we approach the final part, take a moment to recognize what you're doing. You're not just learning where to put money, you're learning how to think long-term in a short-term world. That skill alone can transform your life. In the final part, we'll bring everything together, show how Americans in 2026 can turn this first $1,000 into a lifelong system, and how to stay committed even when motivation fades. This is where everything clicks. Stay with me. Your first $1,000 is no longer just money sitting in an account. It has become a system that works quietly in the background of your life. In 2026 America, where uncertainty feels constant and the future often looks unclear, this system becomes your anchor. Automation is the bridge between intention and reality. When you automate contributions, you remove emotion, excuses, and timing anxiety. Whether the market is up or down, whether the news is good or bad, your system keeps moving forward. Over time, this consistency becomes your greatest advantage. Many Americans who succeed financially admit something surprising. They weren't disciplined every day, their system was. As months turn into years, you'll notice something powerful happening. Your account balance grows, but more importantly, your confidence grows with it. You stop panicking about short-term fluctuations because you understand the plan. You stop comparing yourself to others because you're focused on progress, not performance. This emotional maturity is what allows wealth to compound. Without it, even large sums of money can disappear quickly. With it, even small amounts can grow into something meaningful. At some point, your income will likely increase, maybe through a promotion, a job change, a side hustle, or a new skill you invested in earlier. When that happens, the smartest move is not lifestyle inflation, it's system expansion. Instead of upgrading everything at once, you upgrade your future. You increase your automated investments. This is how ordinary Americans quietly build extraordinary outcomes. They don't wait to feel rich before acting wealthy. They act consistently, and wealth follows. There will be moments when motivation disappears, times when investing feels pointless, times when markets drop and fear returns. This is normal. What matters is that your system doesn't care how you feel on a given day. It keeps working. Historical U.S. market data shows that missing just a few of the best days can drastically reduce long-term returns. Systems prevent emotional decisions that cost you years of progress. This is why long-term investors talk less about intelligence and more about discipline. Another key part of long-term success is remembering why you started. Not to impress anyone, not to beat the market, but to build security, freedom, and choice. Money is not the goal. Options are. The option to say no to bad jobs, the option to handle emergencies without panic, the option to support family, take breaks, or retire with dignity. Your first $1,000 is the foundation of those options. In real life, many Americans underestimate how much progress they're making because change happens slowly. Compounding is invisible in the beginning. For years, it feels like nothing is happening. Then suddenly, the growth becomes noticeable. This is where patience pays. Most people quit right before the curve turns upward. The ones who stay are rewarded disproportionately. This pattern shows up again and again in real financial research and real human stories. You'll also notice that investing changes how you consume information. You become less reactive to fear-based headlines. You understand that volatility is normal, not a signal to run. You begin to see downturns as temporary setbacks, not permanent failures. This perspective is rare, and it's valuable far beyond money. It builds resilience. As your net worth grows, even modestly, you may feel a responsibility to keep learning. This is healthy.
Not chasing trends, but deepening understanding. Learning about taxes, retirement planning, insurance, and long-term strategy. Each layer adds protection. Each layer increases confidence. This is how your first $1,000 evolves into a lifelong education. One day, you'll look back and realize that the hardest part wasn't choosing an investment, it was starting. It was deciding to believe that your future mattered enough to plan for. In a culture that rewards instant gratification, you chose patience. In a system that profits from debt, you chose ownership. That decision compounds just like money does. In 2026, many people will still be waiting for the perfect time, waiting for more money, waiting for certainty. But progress doesn't wait for perfect conditions. It starts with imperfect action. Your first $1,000 is that action. It's not about how much you started with. It's about the direction you chose. If you remember one thing from this entire journey, remember this. Wealth is not built in moments of excitement. It's built in seasons of consistency. You don't need to be fearless. You just need to be committed. Your first $1,000 is proof that you can build something real, something lasting, something that grows while you sleep and supports you while you live. This is not the end of the journey. It's the beginning of a system that can carry you through decades. And years from now, when the numbers are bigger and the fear is smaller, you'll know exactly where it started, with one decision, $1,000, and the courage to begin.